Can you tell us the difference between smart beta ETFs, passive ETFs, and active ETFs?
Yes, of course. As you know, ETFs are typically designed to track the behavior of passive portfolios that normally track a particular market. They can be regional, they can be single country focused, potentially they can be sector focused. The idea of smart beta ETFs is really to go to the next frontier for ETFs, which is you're trying to construct a passive vehicle that tracks a particular theme or a particular characteristic, such as value, growth, momentum, volatility, some clear rule, transparent rule that essentially you can codify that allows you to build a basket of portfolio of stocks that actually tracks that particular characteristic. So that's the main difference between passive ETFs and smart beta ETFs. In the case of active ETFs, the idea of active ETFs is you're trying to capture some alpha in the market. So active ETFs, a portfolio manager is making active decisions about which stocks have to be in or out of the ETF. So it's up to the portfolio manager's strategy and the way that strategy evolves that ETF is constructed. It's much harder to know a priori which stocks are going to be in and out of that active ETF because it depends very much on the strategy or the investment strategy that the portfolio manager is following. Those are the main differences between a passive ETF, which is what you find in the market mostly today, smart beta ETFs, which is the new family of ETFs that are up and coming, and active ETFs, which is yet again another direction that ETF providers are following. So the other aspect which is important is, do these smart beta ETFs really provide you with performance? Obviously, passive ETFs, we know the idea of investors that buy these ETFs is to get the performance of a particular market. So for smart beta ETFs, these are characteristics or themes that portfolio managers over the years have demonstrated provide excess returns. So the idea of smart beta is if you invest in these vehicles, you're going to get returns that go beyond the returns of the market. When it comes to active ETFs, obviously the returns of those active ETFs depend very much on the skill of the portfolio manager. So in that case, it's much harder to predict whether an active ETF is really going to provide returns in excess of the market. In principle, if you put together a combination of a passive ETFs together with smart beta ETFs, the right smart beta ETFs, you should be able to have returns that exceed the market return.
What are the advantages and disadvantages of investing in a smart beta ETF?
So the advantage of investing in a smart beta ETF is that you get good returns for lower cost. Your alternatives as an investor is you either invest in a series of stocks, so an active portfolio, in which case you have to incur high transaction costs every time you get in and out of a position. Or you can buy one of the smart beta ETFs that have much lower cost than an active manager strategy. So they're a little bit higher than a passive ETF, but they're not as high as an active strategy. So from a cost perspective, you should be able to get a good ratio of return versus cost. Yes, when it comes to the actual costs, of course the costs depend on the kind of product and the geography, but typically a passive ETF would run anywhere from 30 to 50 basis points in terms of the overall costs. A smart beta ETF will be anywhere from 50 to 75 basis points, and of course an active strategy can be anywhere north of 75 basis points, 75 to 150 basis points. So there is a significant advantage from an economics perspective of actually investing in the smart beta products.
How can ETFs be used to enhance risk management?
Yes, so absolutely. When you think about ETFs, ETFs can be used as investment vehicles to try to get a certain return for a particular investment strategy, or they can be used as risk management tools. Essentially, ETFs are highly diversified portfolios, so if you hold them, you're likely to reduce the overall risk of your portfolio. In the case of smart beta ETFs, because you're investing in particular themes, you're able to reduce the overall risk if you pick a set of smart beta ETFs which is diversified enough. That's one of the basic principles of risk management, is to pick a set of themes and to invest in those themes so as to reduce the overall risk of the portfolio.